Okay, I'm back. Had a little refreshment, refreshed and ready to tackle on risk analysis of a capital budget. This is again week 5, update video, part 2. All right, let's bring back our spreadsheet. This is the one we just worked on, where we put together capital analysis based on these inputs from a variety of different sources within the company. The company plans on investing $1,000,000. For some companies, this could be an investment of $1,000,000,000, $500,000,000. And how do you project whether that 500 million, $1,000,000,000, $1,000,000 in this case, is going to give you an adequate return? Will you budget for it based on what you plan, how many units you plan to sell, at what price, the inflation rate for those variables over the course of 10 years, the costs, both variable and fixed, the cost of money, the tax rate, and the cost of working capital. All these put together provide a cash flow return. Then we determine the yields or return on those investments 3 ways. Net present value is in dollars, internal rate of return in percentage, profitability index is a ratio of the return to the investment, and how many years it takes us to pay back the investment over the 10 years. Net present value is determining the present value of the cash flow at our weighted average cost of capital, 8.83%, and the difference of that discounted cash flow to the investment is positive net present value. The internal rate of return is using the formula in our function variables of internal rate of return, IRR, under financial, and taking the values of year 0 through year 10, and the logarithm calculates the percentage, IRR function. Same thing holds true with the NPV function. I kind of skipped over that. The NPV function. We go to formulas, function, financial, at NPV, net present value. You type in your discount rate, 0.0883, that's our WACC. And you take the values in this one of year 1 through year 10, and now it discounts that future cash flow at your cost of money, and you get your discounted cash flow, which is used to compute the NPV. The profitability index is the relationship and ratio of that NPV to the investment, $1,060,000. And the payback is how many years to recoup the $1,060,000 investments. Year 1, 2, 3, 4, and 0.94% of the 5th year, 4.94 years to return the investment. Now, what is the risk of this? This is our discussion in this video. If you go to pages 468 and 474, there's highlighted there scenario and sensitivity analysis. These are 2 analyses of what if things change over the next 10 years. See, this is assuming a lot of things are going to stay the same. Inflation, cost, percentages over the next 10 years. What if certain ones of those change? Can we still make a return that's adequate for our company? Let's take the scenario analysis. In this one, our base case or average case is the one we just did. We're selling 25,000 units a year. But what if our marketing people tell us the worst that could possibly happen is selling 12,500 units, which there's a 25% probability of that occurring? And what if our marketing people tell us that if the economy is great, we could sell 35,000 units a year? There's also a 25% probability of that occurring. The scenario analysis is taking these different levels of outputs and their probabilities and determining the weighted likelihood of a return, taking into account weak, average, and strong sales. And that's what it is. So I have set up our base analysis, what we just did. I've also prepared a weak analysis in this tab. This is a weak analysis. As you can see, 12,500 units sold, and everything else is the same. Notice under this scenario, we're losing money. I set up a tab for the strong case. 35,000 unit sales per year. Everything else stays the same. We're making a lot of money there. And then I put it in a chart. It's called the scenario analysis. The average, the strong, and the weak unit sales and their corresponding NPV multiplied times their probability. The average base is 50% probability, if you remember. Strong was 25%, and the weak was 25% probability. Taking into account those NPVs and weighing them by the probabilities, here's our weighted probability, and if you take all those and add them up, it still looks like this case or this project is going to be making money, assuming the likelihood of average, strong, and weak sales. That's the scenario analysis. Now the other analysis is taking the base case, which is this one, which we've already worked on, and changing key variables. Here it is right here. The sensitivity analysis, where we change 3 key variables. Those variables are selected by either the company, your auditors, the bank, and how do these key variables affect the NPV? And the sensitivity is you change just one variable and leave all the other variables the same. Sales price, variable cost, and the WACC. And the deviations are determined by you, plus or minus 5%, plus or minus 10%, plus or minus 15%. In other words, do I change the sales price down 5%, down 10%, down 15%? What's going to be the NPV, and so on? Well, here's that risk analysis. And I've already done it here. Done all the work already. My selling price per unit in the original base case was $20. If I just lower the selling price by 15 bucks, or 15%, excuse me, there's my NPV. I lower the selling price by 10%, there's my NPV. If I lower the selling price by 5%, if I increase my selling price, naturally I'm going to make more money. Here's my original case with no change in the selling price. As you can see, from negative 15 to positive 15, there's a delta of $736,000. And here's that delta shown in this graph right here. This is the line of the sensitivity of selling price per unit. Then I put everything back to original base case, and now I change the variable cost per unit. Lowering the cost by 15, lowering the cost by 10, lowering the cost by 5, naturally I'm making more money. Increasing the cost. Now notice my delta from minus 15 to 15 here is only 293,313, and here's that line here going the other way because it's an expense. But notice it's a lot flatter, not as much delta change. And then finally I put everything back to 0 and I do the WACC, the weighted average cost of capital, which is right here in the discounted cash flow. So I change that by lowering the WACC by 15%. Naturally I'm going to make more money, 10 and 5. I increase the interest rate by 5, 10, 15. Again, I make less money. But here the variance is only 190 from minus 15 to 15. And note the curve here. What does this tell us? Naturally, it's pretty common sense that selling price has the greatest sensitivity to profitability. We change that either way. That line is very steep in slope, meaning it's very sensitive. Whereas the selling price or variable cost per unit and the WACC, the cost of capital, if those have fluctuations, the probability is effective less because the lines are more flatter. Why is this important? Because you know during the course of the project, year 2, year 3, if in order for you to sell 25,000 units, which is the original base case, and you have to start lowering the price to do that, with all the other variables and the costs remaining the same, if you start lowering the price, you're going to lose money. And if that continues on throughout most of the project, you might have to make some changes into your cost structure or something else during the course of the life of the project. Or if you have variable costs, which could be a new labor contract, and those go up, does that affect the cost as much as a change in sale? And in this case, naturally it doesn't. But it's good to be aware of that. And also if your cost of money changes over time. Your cost of money will go up if your risk increases with your business. Your cost of money will go down if the risk depreciates in your business. What could drive the risk up? Maybe the market might think you're crazy getting into this project, and your cost of money would change over time because of the risk of that particular project. Good example of that is about 15, 20 years ago, Coca-Cola created a new Coke. I don't know if some of you remember that. Most of you probably weren't even born then. A new Coke. And they invested over $1 billion into this new recipe for Coke and marketed it and was willing to sell it. Well, they quickly found out that their sales projections, in order to meet those, they would have to lower the price of the Coke, of the new Coke, because a lot of people didn't want it. At the same time, the market increased the cost of their money because they thought that Coca-Cola was crazy. Why mess with a good thing? Why aren't they keeping the old formula? Well, Coca-Cola, after about 2 years of this $1 billion investment, pulled the plug and got out of it. It was a loser, and they dropped out, ended up losing about $500 million, but at the same time went back to the old formula and kept the company solvent. If they would have gone ahead with this new Coke, many believe the company would have gone bankrupt. So the sensitivity of money, the sensitivity of costs, the sensitivity of selling price is analyzed in their determination of profitability and return, NPV, by this analysis. You need to review how I did this, how this all takes place in this spreadsheet, because we're going to have some questions on this in next week's assignment number 3, or case number 3. So that's our discussion for this week. Please review it. Again, we'll have more discussion on this next week, because next week, as you can see, we have a capital budgeting case which will be distributed, which is due December 1st. That capital budgeting case will be this analysis and your interpretation of it in a paper/spreadsheet analysis, and we'll talk more about that next week. Thanks, everybody. Good luck on your work this week, and I'll talk to you all on Monday in regards to our next topic next week, which is further analysis of this capital budgeting strategy. Have a good weekend. Where am I? Here I am. There I am. Have a good weekend, everybody, and we'll see you on the WebEx, every one of you, next week during your appointment times. I'm going to send out the links as soon as I post this video. Talk to you later.